How's the weak economy created investment opportunities in companies that are facing restructuring or financial difficulties? Well, Varun Bedi is the Chief Investment Officer at Tenex Capital Management, and Tenex specializes in corporate turnarounds. Now, before joining Tenex, Varun was a senior vice president at Cerberus Capital, where he oversaw the restructuring of many high-profile companies. Now, good to have you with us, Varun.
Thank you.
One of the questions to sort of begin is restructuring in an environment where you don't seem to have a lot of forced bankruptcies because of all the covenant-light issuance that we experienced. Is there a bigger market for restructuring somewhere in the future, or are we putting off some kind of disaster?
Well, I think it does seem like people are giving the all clear in the restructuring world. Disney and IBM have raised debt at 1%. A lot of the levered loan businesses, maybe 10 to 20% of the most distressed companies, have taken advantage of the low rock bottom interest rates to help themselves a little. There was going to be the mother of all distress cycles. We were all talking about it in this business, 07, 06, 07, 08. It came, and it seemed to have gone. At least people think it has. Our view is very different. It's a tale of two cities. It's really actually a dirty little secret. What people don't realize is the distress hasn't stopped for the smallest companies. It continues for those companies that are under $500 million in revenue, even today, who have difficulty accessing the bond market, which is where the largest companies have availed themselves of. They're still in trouble. And in addition to that, to your point, there's a huge wave of defaults that instead of happening in 2010 and 11, they're still waiting to happen. They may happen in 2012 and 13.
So all of those firms, whether they be law firms, accounting firms, or restructuring firms that went on a hiring binge to sort of add to the ranks of people who are expert at restructurings and bankruptcies, it's just going to take a longer amount of time to utilize all those skills.
I think that's exactly right. What's happened is it's very similar to the investment banking world. You have some layoffs at restructuring firms, and you have the remaining people going down market. So like Goldman or Morgan Stanley in a bad M&A market would start going after the smaller deals. We're seeing in some of the companies we look to invest in this distressed world, we're seeing a lot more of the big name advisors come from companies that are really much smaller than we're used to seeing them. The fact is, something changed. The banks 2 years ago were in trouble themselves. They couldn't take write-downs on the largest levered loans in their portfolio. So what do? They kicked the can down the road. They amended to extend, to pretend in some cases. Well, guess what? They got a little bit healthier in the last year and a half. And there's now those big companies, they've probably given a couple more years to. And they're the ones who are going to hit the wall in 2012 and 13. The smaller companies, they've gotten more aggressive. For those, think of it as small companies, gum stuck to the bottom of your shoe, they've got to fix them. They've got to do something with them. And if they're companies that are not just broken balance sheets, but in fact their operations are challenged, you combine that toxic mix, and the banks are saying, I'm done with you. It's time to put you out, and they're not giving them the leash they used to.
So Varun, the idea being that the banks are starting to get real because, in a way, they can afford to now. They've got that cushion of capital that they've built up.
That's exactly right. The small companies are feeling the brunt of it, again, because they don't have the benefit of what the larger companies
They're not going to the public market. They're not issuing new debt. They're not getting a lot of access to to second lien markets, for example.
Exactly right. Now, that's the small companies. I don't see any stoppage, maybe a little bit, in their pain for the next 2-3 years. They're going to have to deal with this. You're going to continue to see more of, before it was an absolute ocean, but a strong stream, unfortunately, of these bankrupt smaller companies. What, on the other side, 2-3 years down the line, what you will see is, over the next 3, 4, 5 years, you have $800 billion of leveraged loans that have to be refinanced. It's a big number.
$800 billion.
Which you're talking about probably 900 plus companies. Let's say there's 1,300 total levered companies in the large company atmosphere, in the environment. Of those, 75% have to refinance them over the next 3 to 4 years. For 2010 and 11, they're okay. I don't think you're going to see a huge pop in defaults over that time frame. But after that, the history is when you are a company that someone amends to extend with or does a distressed debt exchange, 30 or 40% of those historically redefault. A lot of these companies are betting that growth will bail them out. A lot of them are backed by private equity firms who are hoping, hey, I've been able to get some patience from my banks, and now I need some revenue growth. Well, here's the problem. That revenue growth isn't materializing, as we all know. It's, call it new normal, call it what you will. Let's hope it's not a double-dip recession. But these companies need growth to materialize, or they're going to be at serious danger of re-defaulting.
Well, they also need new capital. You're saying there's very little access to that because there are also fewer exit strategies now, right? IPO market, we had Liberty Mutual saying we're not doing the IPO because of the environment right now.
Unless the economy speeds up a little bit, at least from 1% growth. I mean, I think of it this way. If the government hadn't added maybe 2 points of stimulus annually, we'd be in potentially in a contraction right now. And these companies, you know, you took a big risk. You said, I'm going to put a ton of leverage on it, and I'm going to assume the old private equity model works. It doesn't. You need to fix your operations. And we see this across the companies we work with or are looking at as investment opportunities. And we tell these companies, you can no longer wait for growth to bail you out. You have to take an action.
Last question for you. Are there specific types of companies that are going to sort of be the warning signs for when this starts?
If you look at specific sectors, look at media, home builders who might have a double-dip recession in housing, print publishing specifically, auto suppliers, and even gaming. Those four to us are leading indicators. They're still in distress, and the question is how many of them will make it.
All right, Varun, keep us up to date. I appreciate it. Very insightful, very informative. Thank you very much. Varun Bedi coming to us from Tenex Capital.